All right, so it seems like my camera's working so perfectly. We can get back to sharing the screen of the presentation. All right, seems like we're up and running. So the purpose of life insurance, what I first want to say, in honor or respect to some frequent things that have, or some recent things that just happened. There are two stories, unfortunately, of some people that have passed that were not immediately close to me personally, but they were friends or relatives of friends of mine. So I do want to just start by saying life is truly precious, right? What I love about financial planning is a personalization that goes behind financial planning. And the most important aspect of a plan is the individual. And truth be told, it's you. So I do want to take a moment just to appreciate what life is, what life has to offer, and just pay my respects to those who have recently passed away. With that, I think it's a perfect moment to just address again the purpose of life insurance. So just a brief introduction to who I am. My name is Marcus Rather. If you're not familiar with who I am a licensed financial advisor. My office is located here in the Richmond area, and I'm a financial advisor of a company called Cetera Investors, which is a part of Cetera Financial Group. So Cetera Investors, we specialize in holistic financial planning, servicing our clients throughout not just the state of Virginia, but wherever our clients are. So I have a pretty expansive territory, whether it's as far up north as Maryland and DC, or as far south as Florida, and a few states out in the West. So why does anyone buy life insurance? There are plenty of reasons as to why a person or family will purchase life insurance. For today, for our conversation, I'm just going to hone in on those 4 bullet points that you see. Number one, the epitome behind life insurance is protection. There are 2 things that are for certain, especially being a citizen of the United States in our life. For everything, for everyone, there's an end date, right? We're all going to experience death in some way. But then there's always taxes that you'll have to pay, right? So 2 things for certain are death and taxes. And life insurance is honestly used for both scenarios. So protection is a main bullet point. Life insurance can also be used as a form of income. It can be used as an asset. So you can see retirement income plan. Life insurance can also be used as a way to develop or protect a legacy and effectively transfer any wealth or assets that have been established or may not have yet been established. And then finally, life insurance can also be used for long-term care. So we're going to briefly just talk on about that. So protection, the main reason for life insurance is protection. I know many people use life insurance as other means, whether it's as, again, income and retirement, whether it's for estate planning, tax efficiency. But I don't want there to be any misunderstanding or misconstruction of what life insurance is. It is mostly and almost exclusively used for protection. So the things that most people think of when they're talking about protection, first thought that comes to mind is generally final expenses. Those final expenses that are associated with any burial, any cremation, any medical expenses from hospitalization, those types of expenses. Second type of thing are any debts that may be outstanding, whether this debt is in the form of a good debt like a mortgage, or maybe even a business loan or something along those lines, or if it's consumer debt, things like car loans or credit cards or education or student loans. Generally, families want to have enough money to cover those types of expenses, whether they're final expenses, paying off debt. But most families that I've seen overlook the value of income. When someone passes away, not only are they gone, but the resources and their ability to produce that income, if it was while they were working or even if they were in retirement, generally that income stops. So with the loss of a breadwinner or maybe someone that supports a dual income household, upon passing away, there's some type of change in income. So we always want to protect those things that matter the most, which are generally expenses, income potential. If you're a young earner or someone nearing retirement or even in retirement, the loss of working income, the loss of a pension, the loss of Social Security, providing resources for college education or any other major purchases that you may have been planning to purchase that unfortunately won't be able to be purchased because that person is gone. And then certain protections around businesses, business owners. Maybe you need something like a buy-sell agreement to protect the ownership of the business, or key man insurance to protect a key employee from no longer being able to work in that capacity at the business, or simply just buying out the owner of a business in terms of partnerships and things along those lines. So there are many different reasons, but what are we protecting can generally fall under those different examples. So ways that you can provide that protection, right? Typically set up to buy the highest death benefit with the least premium. A lot of those needs that you saw previously are actually temporary. When we think about certain forms of debt, right? Mortgage, which for many people feels like it's going to be forever, they do have an expiration date, right? Whether it's 15 years, 20 or 30 years, or maybe even 40, there still is an end date. Or if it's income protection, generally the amount of income that you need to provide is very high, especially if you have young children that you may need to provide for 18 or 22 or 24 years. Or if it's a couple that's entering into the early phase of their retirement and they're expecting to live 20 or 30 years in retirement. Again, not a forever lasting type of need. It is typically temporary. Same thing with business ownership and things along those lines. But then there are some things that always are going to exist, right? Again, taxes, final expenses, the desire to leave a legacy to your family. Those types of needs typically may be a long-lasting need. So common ways to structure the protection to address those needs can be either one simple term policy or one universal life policy with a return of premium, or as you can see, universal life or whole life with cash value growth to protect for more years. Again, depending on your situation, depending on your circumstance, you may need a package deal. You may need insurance that includes both universal life or whole life policy and a term life policy to cover those temporary needs, like a 30-year mortgage. So there are many different ways to put together that portfolio, but these are common ways to structure that protection insurance just to cover those temporary needs. Shifting gears, moving away from the protection component of where life insurance fits in the plan, life insurance can also be used as an asset to provide income in the future, whether it's later in retirement, at retirement, or even if someone's looking for an early retirement. Life insurance can be used for income. Now, this is typically best designed if the income is not needed sooner than 10 years. Personally, I think it's best to plan for 15 years or longer of funding or investing in life insurance with the intent to develop income as a retirement asset. So one of the key features of the strategy is to structure the distributions so that they are all income tax free from a life insurance policy. So what do I mean by that? So life insurance as we know it, upon the passing away of an individual, the death benefit is tax free to the beneficiary. In many cases, it can be tax free. It may be subject to estate taxes if your estate is worth 13 or 26 million, depending on the situation. But in many cases, your average individual, the death benefit of life insurance is tax free. But for those policies that accumulate cash value, right? Policies like a whole life policy or an index universal life or a variable universal life policy, these policies accumulate cash value. And the cash value is commonly known as a living benefit, not necessarily a death benefit. It's a benefit that you can take advantage of while you're alive. So these are, the ones that can accumulate cash as you own them. And there are certain ways that you can access that cash value in a tax efficient manner, whether it's simply just surrendering the policy and getting the cash back. There may or may not be a tax liability with that. But most commonly, you can take a loan against the cash value in a permanent type of policy, the policy that you see on the screen. And with taking a loan, that is not a taxable event. So there are tax efficient ways of accessing cash value within these types of policies that you would typically use to develop an income plan for either retirement or prior to retirement. So here's some important details that you want to understand when it comes to funding a policy like a permanent policy with the intention of using the cash value for income. So one, there is this thing called a modified endowment contract. So I'm gonna start there. MEC, modified endowment contract. A modified endowment contract is a tax qualification of a life insurance policy whose funding exceeds federal tax law limits. So prior to, I can't quite fully remember the year, but there was a time because of that tax advantage of cash value where you could just dump as much money as you possibly wanted to in a life insurance policy and receive the cash value in a tax advantage way. Well, IRS caught wind of that and they started to set limitations of how much money can truly be funded into a life insurance policy in proportion to the death benefit before it loses that tax advantage, that tax qualification. So there are certain limits that you can put into a life insurance policy to keep it as a tax advantage asset. And if it exceeds that amount, then it can become what we call a modified endowment contract, meaning it loses a lot of those tax advantages because of how much money is funded into the policy. There was a gentleman that I met once before. He was associated with Foresters Financial, and he saw modified endowment contract as something different. He called it maximum efficiency contract, where typically a modified endowment contract will tell you how much you can, what's the maximum amount that you can pay into a life insurance policy to keep it as a life insurance policy. He saw that in the opposite direction. He said, well, this is the maximum amount that you can pay into a policy without losing that tax advantage. So he saw it as maximum efficiency. How can I get this policy to be maximized within the cash value and the tax-free component? So the policy is typically structured to put the maximum amount of premium into the policy with the lowest possible death benefit that will avoid the policy becoming a modified endowment contract. So in the bold, you see at the bottom, changes taxation of withdrawals from the policy. So we're not tax advisors, we're not tax professionals. So of course, any specific tax questions you have, you will want to consult with your trusted tax professional. But within life insurance, there are some things to keep in mind when it comes to maximum efficiency or modified endowment contract. So to give you a visual, right, we talked about, well, what's the maximum amount that you can put into a policy without compromising the tax efficiency? On the left-hand side, you're going to see a traditional design. So for someone that's simply just looking to have the maximum death benefit, this is focused on protection. The reason for our policy, the reason for our life insurance, we're looking for that to provide protection. Generally, you're just looking for the minimum premium payment. You don't want to pay more than necessary to get the adequate protection that you need. But if someone's looking to maximize the efficiency of their life policy and use it as a financial asset that can be used for income, generally you're looking to have the minimum death benefit and looking to have the maximum premium payment. So going back to the types of policies that fit this design, generally you find these, yes, you can have these with whole life, but most flexibility will come with policies that are known as universal life policies. Whether you saw index universal, variable universal, not going to go through the minutia of what separates those, but understand the difference between universal life and whole life is that whole life is going to typically be more like vanilla ice cream. It's more cut and dry. The premiums are fixed. The premiums are level. The premiums are guaranteed. So that dollar amount that you pay for the policy, you're not going to pay more than what's specified. And the death benefit is generally level, right? It's going to be guaranteed. So whatever the death benefit is on day one, likely will be the same amount 30 years from now, right? So you don't have a lot of flexibility with whole life policies. You have some, but not a lot. With universal life, think of that as like a hybrid. That might be like a Neapolitan ice cream, or like I said, a hybrid car. What a universal life policy is like buying a term policy, but funding it like a permanent one. So there's a little bit more flexibility that you have with universal life, where the death benefit can either be level, so it can be similar to whole life, or the death benefit can increase. You can have it grow. The way the cash value can grow is can be variable, or it can be indexed. That's where variable index universal life comes from. But another flexibility with all types of universal life policies is that the premiums can be flexible. You can specify to pay more, or you can specify to pay less over time. So with universal life policies, there's a lot more flexibility that can fit the design of having that enhanced design and accumulation value. I'm gonna take a quick pause there, check my Q&A box just to see if there are any questions from that thus far. But on the screen, if you're looking, we're looking at a case study. So what I will say is that this case study of using life insurance as an asset to produce income, it is going to be more effective if we're looking to, again, have that maximum efficiency. So in this example, we have a male age 45. Health-wise, he came back preferred non-tobacco, meaning he's not a smoker. His health is he's in excellent health. So his cost for the life insurance is a lot more feasible. But what he's looking to do is, this gentleman is looking to maximize that efficiency of the policy. So his annual premium is going to be $20,000 a year. Again, may not fit for someone that's only looking to save or pay $100 a month. But if someone has a lot of earnings where you're not eligible for things like a Roth IRA, or maybe you don't have access to an employer-sponsored plan, whether you're a highly compensated individual or maybe you're a business owner, and you can afford these level of premiums, this is an idea that you may want to consider. So annual premiums of $20,000, and from 45 to 65, he's going to pay that $20,000 every single year. So what you see is over his life of the policy, he's totally paid $400,000 into the life insurance policy. Now, the way this cash is going to grow, we're going to assume it grows by 6.5%, more commonly associated with a variable universal life policy. And what you can see is the net cash value in year one at his age 45 is not equal to what he's paid in premium. So I want to pause here for a second and emphasize, life insurance is not purely an investment. It still is life insurance. So $20,000 invested in a liquid account, like an investment account, retirement account, whatever the case may be, is going to be a bit more effective than just simply using a life insurance policy. Life insurance is still life insurance. But one of the advantages to this is that, again, this cash value is going to gradually grow on a tax-deferred basis. So there is no taxes on the growth of the cash value as he continues to pay premiums into the policy. So you can see by the time he turns 65, traditional retirement age, he would have accumulated $682,000 in cash value within the policy, increasing his net death benefit to $1.1 million, and he still only paid $400,000 in premium. Seems like a very efficient contract. So should he pass away, his family will get the 1.1, whomever his beneficiaries are. Should he decide to surrender the policy, he would get the cash value back. Now, what you can see here is $682,000 clearly and happily is more than $400,000. Problem is, if he surrenders that contract and gets all $682,000 back, he will have a taxable gain of whatever the difference is between his premiums paid, $400,000, and the cash value received, $682,000. So there's $282,000 of taxable gain that he'll pay in the year that he fully surrenders the policy. So ways that we can distribute that income is through a mixture of either withdrawals or loans, because remember, loans against a policy are not taxable, you can distribute this income over your retirement through a mixture of withdrawals and loans. So we took an annual withdrawal of $53,000, giving him the income that he needed for retirement. And what you'll see is, because the cash value continues to grow by 6.5%, by the time he's reached 84, assuming typical mortality for a male, he's withdrawn $1.62 million in tax advantage income, with still having $87,000 in cash value and $127,000 in death benefit. Now, at this point, I will emphasize there may or may not be some taxable gain should he pass away, but the death benefit typically is tax-free. And again, consult with your tax professional in terms of any specific tax questions. So this is a very high case study, but just wanted to share an example of how life insurance on a maximum efficiency contract can be used as an asset for tax advantage income in retirement. So again, going to pause very quickly just to see if we have any Q&A before we move to the third bullet point. All right, no questions. We're going to keep on rolling. So point 3 was legacy and transfer. So life insurance is one of the few vehicles that can be used in a tax efficient way to leave a legacy or to transfer wealth. So when using life insurance to provide a legacy for another person or entity, the life insurance is often creating wealth versus simply transferring wealth. As an example, for someone that is a young person or a young family or even middle-aged family whose death benefit may be more than their assets, maybe they haven't fully accumulated all the money that they need for retirement, or maybe they don't have many assets yet, but have a high responsibility. Upon the passing of that individual, they've now created wealth versus simply transferring the wealth that they currently own. So there's a lot more than just transferring wealth when it comes to life insurance. A few strategies that you want to consider if your plan is to look or to leave a legacy or to transfer wealth. First, you want to be familiar with what your assets are, whether they're property and home, valuation of businesses, investment accounts, retirement accounts, bank accounts, etc. You want to be familiar with what those assets are. Secondly, you want to consider what are the tax ramifications of passing those accounts on. Generally, pre-tax or pre-qualified accounts like 401ks, TSPs, 403bs, where money were put in on a pre-tax basis, those assets will be taxed to the person that inherits those dollars. Now, there are some efficient ways of minimizing the tax burden, but we can't undo the tax liability that's owed on taxable assets being passed on. So what you want to keep in mind is, again, understanding what your dollars are, understand the tax ramifications, and you want to consider how to leverage those dollars, how to preserve your pension if you have a pension, or even Social Security, how to have your beneficiaries treated fairly in terms of having equal representation or equal estate size, and how to avoid making the government the largest beneficiary of your qualified funds, i.e. IRA, 401k, pre-tax money. A few other things of understanding why life insurance is important: avoiding probate. So as equally important as it is to have the life insurance in place, you also want to be sure that you have the proper legal documents in place and that you properly appointed beneficiaries on any type of accounts that you have, whether they're bank accounts. You can have payable on death designation. With certain property in certain states, you can have payable on death designation for transfer of deed designations for certain personal property. Retirement accounts, life insurance policies, investment accounts, you can have them registered with a beneficiary. Those are significantly important. If you're someone that's looking to gift certain assets, there are effective ways of gifting money to a individual, to a business, whatever the case may be. Just please understand, we're not CPAs and clients to consult a tax advisor for any specific tax questions or tax regulations that they have in mind. So a few common ways to structure or to use a life insurance policy as a way to transfer the legacy or to create the legacy. You can have a single premium simplified issue policy. So instead of the premiums being paid every month or every year, if you have the assets, you can have a single paid policy. Those policies can be either a whole life or a universal life or an index universal life policy. You can have what they call second to die. These are most associated with couples or families who don't necessarily need to leave the legacy after one person passes, but after both people pass. And this is generally helpful to avoid any estate tax issues, to maximize the tax efficiency of that legacy. So the second to die or a survivor policy can be a whole life, it can be a universal life or some variation. And then you can have regular, traditional, fully underwritten life insurance, which are all the types of policies available: whole life, universal life, term, etc. So want to bring to example a pension max case. I have my favorite couple, Aunt Viv and Uncle Phil from Fresh Prince of Bel-Air. Aunt Viv has a pension that will start at age 66. And she has two options to structure the payout. She can either choose a joint life pension, so it's protecting the income for her life and Uncle Phil, and that will provide her $4,300 per month before taxes. Or Aunt Viv can maximize her pension and take the maximum monthly benefit of $5,500 a month, and that will benefit her as long as she lives. Now, that puts Philip at a risk in the event that Aunt Viv passes, where that $5,500 per month will end. Well, simple thought is, well, if I simply just want to protect the income for as long as I may live or short as I may live, why don't I just choose the joint life option? Well, now that puts Aunt Viv at a point of a risk because, well, what happens if Uncle Phil passes before Aunt Vivian does? Well, now Aunt Vivian took a $1,200 month reduction in her benefit to protect the income for Uncle Phil. But if Uncle Phil passed before Aunt Viv, well, that's money that's now gone that she can't recuperate. So when we look at pension maximization strategies, we simply look to maximize that efficiency and protect both parties, right? So you can see the pension option if they're both living. The joint life is $4,300. If Viv continues to live, but Uncle Phil passes away, she'll continue to get the $4,300. And I apologize for the typo, but if Uncle Phil continues to live and Aunt Viv passes, she'll actually get $4,300, not the $5,500. Now, if she chooses a single life with insurance, say we can purchase a life insurance policy where the $1,200 per month, complementing that income strategy we mentioned before, can purchase a life policy with a death benefit of $300,000. Well, that can replace a substantial portion of that $5,500 a month. So let's look at if they're both living. They're paying, Aunt Viv is now earning the $5,500. She's still willing to live on the $4,300 per month, but she's putting that $1,200 into a policy that's owned by her. It's a permanent type of policy, so it's going to accumulate cash value. And she has the flexibility of changing the beneficiary. She has the flexibility of changing the premium. So let's say Uncle Phil does pass and she chose a single life option. Well, now she can still earn the $5,500 a month in her pension, but now she has the flexibility to either keep the policy and continue to pay the $1,200 per month premium, which would allow her to either change the beneficiary of the policy at no extra cost, so that money can still be passed on to someone that's very important to her, or she could surrender it and get whatever cash value back is in the policy. And that can either be a tax-free way, or she can use that cash value as income. In the event that she passes, well, Uncle Phil's still living. No, he would not get the $5,500 per month, But what he will receive is $300,000 tax-free. So instead of $5,500 taxable income every month, a little bit more than $60,000 a year, now he's received $300,000 tax-free, at which now he can earn that income or spend that money down in a very tax-efficient way. So just to reiterate the value of having that flexibility with a pension maximization strategy or using life insurance to maximize your pension. The main bullet points here are just one, flexibility, because in the event that Aunt Viv passes away, again, the income can continue on to Uncle Phil, but in the event that Uncle Phil passes and she chooses the survivor option, she loses that $1,200 a month that she theoretically would have paid back to the pension plan to protect that income. And in the event that no one lives, so let's say, both parties pass away, well, that's just the end of that complete income. That's the end of that asset. At least with life insurance, there's always a death benefit that will be paid out. So if Uncle Phil passes and Aunt Viv chooses to keep the policy, again, there's still $300,000 that's tax-free that'll be paid to some person, some company, some organization. So that brings a conclusion to the presentation this evening. Checking again for Q&A, but to bring things to a close, as you can see, there are many different ways of how you can incorporate life insurance within your financial plan. The main important details are understanding that, one, you are the prized possession of your plan. Nothing is more important than you and what matters to you and your family. Secondly, life insurance is still life insurance. It's not an investment product per se. I'm not going to over explain something or try to make something more than what life insurance truly is. It is used for death benefit. And at the end of the day, when it needs to be used the most, the questions that I've been asked the most are, am I going to have enough to be okay? Right? I have plenty of stories, unfortunately, but plenty of stories where I've been working with survivors of a loss, whether it's a widow, whether it's a child, whomever the individual may have been. And none of them have yet to ask me what type of policy their loved one had. They did not ask me if it was a whole life. They did not ask me if it was term. They did not ask me if it was pension max. But what they were thankful for is that the benefit was there and that they were thankful that it was enough to sustain their standard of living. So these are all just additional ideas of how, again, you can incorporate life insurance with financial planning. As always, if you have tax questions, consult with a tax professional. If you have financial questions, consult with me. I'm your trusted financial advisor. So with that, no other Q&A. So I'll bid everyone a good evening. Thank you for joining, and I can't wait to see you on the next session. Take care.